Hello, everyone, and welcome to a special Fat Profits webcast today, where we're going to focus on the Asian market update. I will be the host, Patrick Ganley, along with Angus Geddes. Angus, how are you today?
Hi, Patrick. Yeah, good, thank you.
Okay, so we'll get into the special presentation today that we're doing. Here we are, both Angus and Patrick will be conducting the webcast today. A little bit of housekeeping before we get started. All the information presented in the presentation today is for general advice only. Before acting on any of the investment objectives or ideas in this presentation, please be sure to consult with a financial advisor or consultant before doing so, and please be reminded past performance is no indication of future returns. During the presentation, you will be able to answer questions. You can type the questions in where the orange arrow is. We will do our best to cover those questions that come through during the presentation. If you're having difficulty hearing us, please feel free to give us a call in the office, 1-300-88-1177, and we'll try to help you with your technical issues when we get your call. So without further ado, Fat Profits market update. The focus today is going to be on the Asian markets, which is something that Angus has been talking quite a bit about, both in the webcasts we've been doing as well as the daily. So without further ado, Angus, I thought we'd look at the opportunity in Asia, the coming new bull market in China, and we've got an interesting chart here for you to talk with.
Yeah, so obviously, we've sort of gradually changed our view on China and Hong Kong, but if you look at the price action over the last 5 years, China and Hong Kong stocks have been in a really nasty bear market, and I think there's quite a convincing case now, Patrick, that those stock markets have exited a bear market and now, early stage at the beginning of a new bull market. It's the old saying, bull markets are born on times of sort of maximum pessimism. And I think, there's a pretty good argument that we could make that, sentiment is very bearish towards China, Hong Kong stocks at the moment. We even had that word uninvestable from a lot of sort of analysts, even sort of 3 months ago. But just to summarize, I think, technically the CSI 300's broken out. This sort of primary downtrend that's been in place since 2021. We're sort of seeing sort of green shoots sort of come through in the economy. They're not out of the woods yet, but as you know, stock markets look forward, they look into the future and discount. And I think this better price action that we're seeing in the CSI 300 and also the Hang Seng points to better times ahead for the economy. And as Warren Buffett, famously once said about recessions and buying stocks during economic downturns, he said, if you wait for the robins, you'll miss the spring. And it's a little bit like that, I think, with those Asian stock markets moving higher, and probably a lot of people still sort of scratching their heads as to why. And it's not so much where the economy is at today, but where it's going and where it will be in 5 years.
Okay, so if we move to the Hang Seng, it's been the best performing index this year, arguably. And here's a good chart showing the movement that we've seen recently.
Yeah, well, it has been the best performing market. I mean, from 15,000 up to 19.5, that's a move of nearly 30%. It wasn't that long ago that, I was sort of writing in my note that, I thought better times were ahead for Hang Seng and the CSI 300. So we've had this decent move. The breakout from those levels around 17,000, we've had quite a decent move to the upside. And of course, we might see, in coming weeks, in the coming month, we might see a bit of a pause, a bit of a consolidation. But I think the path of least resistance is higher for the Hang Seng and the CSI 300. Valuations are still very, very cheap. And, we're finding lots of opportunities over there in terms of companies that are exhibiting strong, top line and bottom line earnings and revenue growth.
Okay, now that we've looked at those two charts, we've got the Hang Seng PE historically troughed at 6 times. So that looks relatively cheap. Is that correct, Angus?
Yeah, I think, historically, 6 to 8 times has defined the bottom of any bear market. We saw that in the 1930s when the Dow bottomed out at 8 times in the Great Depression. We've seen a similar multiple, probably a little bit more than 6 to 8 times in the UK recently. So, yeah, look, I think, stocks are cheap. And the point really to make here is, in terms of Asia, some of these companies are growing quite strongly. GDP growth in China is still quite strong. It's more than 5%. China doesn't have the inflation problem that a lot of other countries have. You make a pretty good argument for it, given that the US market is trading at nearly 22 times earnings. So there's quite a high degree of margin of safety priced into those Asian markets, which is one of the reasons I'm quite keen on it. And given that margin of safety, given the fact that valuations are cheap, there's just simply a lot of bad news that is priced in. And I guess one of the reasons why I've sort of got quite high conviction that Hong Kong Chinese stocks have exited the bear market is they're no longer going down on bad news, and we're not getting the flow of bad news that we were, perhaps 6 to 12 months ago. Although I do note, in April, residential housing prices fell. I think it was had the steepest decline on record.
So I thought we'd talk a little bit now, what is driving the China turnaround? And I know you and I had a chat this morning about some of the new things that have come out of the government underpinning the residential property market in China, which was quite a big move given all the residential property that's still available over in China. But I thought we'd just talk a little bit about what the key drivers are at this point in time.
Well, I think there's a number of factors that's driving the turnaround in the stock market, and probably at the top of the list is the cumulative stimulus measures that the government and the authorities have thrown at the economy over there. They're finally sort of beginning to add up. Sure, there's been a lot of disenchantment from markets and from analysts over Beijing's refusal to fire the fiscal stimulus bazooka. There's been a lot of disappointment, but I would say that that's pretty much all priced in. And probably, to be fair to Beijing, they just didn't want to overstimulate the economy in the way that they did in 2012. They probably learnt from that. Beijing doesn't want another housing bubble. So they've sort of refrained from that, and they're letting the property market pretty much clear itself. But there has been some initiatives, in the last couple of weeks, such as a plan now for the government to buy a lot of those vacant, empty residential housing blocks and repurpose that into affordable housing. So that's underway, and I think that's probably going to have some sort of a positive impact. We've already seen the property stocks rally significantly in the last few days on the back of that. And I think that the sooner the housing market finds a bottom, it can then begin a sustainable recovery. And we're probably closer close to getting closer to that happening. The property market really has been a one of the key reasons that the US, well, I should say the China consumer has been under pressure. So anything to sort of sort out and stabilise that property market has to be a good thing. A lot of investors forget that GDP growth over there is still pretty strong at 5+%. Hard to find a market anywhere where the economy is growing at that rate, and albeit it's not the 12% that China was once growing at, but it's still high. And even in real terms, when you back out inflation, and China doesn't have an inflation problem like a lot of other markets, the real GDP growth rate is still pretty strong. The rest of the world, continues to battle inflation, Patrick. China's has had the other problem, and that is price deflation. Although prices seem to be sort of stabilising over there, but the point there is that the central bank doesn't have a huge problem, and they've had the ability to ease interest rates, which is what we're seeing. I think the other point to make about China, Hong Kong is that the labour markets are nowhere near as tight as what we're seeing in the West and United States, Australia, the UK. We've got quite high youth unemployment over there. So China just doesn't seem to have the same sort of upward pressure on wages, excuse me, as some of these other markets. And as I said before, valuations are historically cheap. So I think there's a number of factors that are driving this turnaround.
Okay, now that we've gone through that, I thought you and I'd have a little bit of a talk about ways to play Asia. We've been getting quite a few questions recently from members who've been reading your daily note, and where you're talking and becoming more positive on the Asian market. And members are asking, what's the best way to play it? So I thought we'd kind of step through a few of those here. And I know you're off to Japan for a conference in the coming day. So I know we're going to start with the Japan financials, banks, brokers, insurance companies.
Yeah, so in terms of our separately managed account Asia model portfolio, we really overweight these Japanese financials, the banks, the brokers, the insurance companies, and they've all got positive correlation to bond yields, certainly the banks and the insurance companies. So, Japanese interest rates have been repressed for a long period of time. They were artificially managed down to 0%, or close to it. So, the banks and the insurance companies were really starved of yield, and found it very difficult for decades to make money in that environment. But that's all changing now. We've got the Japanese central bank moving down the path towards policy normalization. We've seen the 10-year JGB yield hit 1%. It's probably going to go a lot higher. So, unlike a lot of other companies around the world that are going to struggle with high bond yields, and I think we are in a secular bear market for bond yields. It's a great outcome for the Japanese financials, and we're going to see their net interest margins expand. So we've been on the Japanese banks, Patrick, as you know, for quite some time. I still think there's further to go in that bull market. We like the large cap internet technology stocks based in China and Hong Kong. We're quite focused on specifically that sector, and we're not really playing around in the industrials or the banking sector or anything like that. Really focus on those big, high quality, large cap IT companies, such as Tencent Holdings and Alibaba. There's a number of them that we hold, and simply because their valuations are low, certainly by US counterpart standards. Their balance sheets are strong. They continue to buy back large amounts of shares, whilst valuations have been under pressure, and they're, they're growing. Even the companies that have slowed down and have low valuations attached or ascribed because of that, we're seeing revenue growth still coming through. So that's pretty much how we're playing it. I also think commodities are a great way to get exposure to the turnaround that's potentially coming for China's economy. We're on copper, gold, base metals, and energy, and I think they are all commodities that will probably do a lot better as China rebounds.
Okay, so I think we just have a quick look at the Japanese banks in a powerful bull market, and this is this chart's really pointing that out now. How the banks are in a bull market in Japan.
Yeah, so this is the Refinitiv Japanese Bank Index. We started buying the banks when the index was around 50, so we've doubled our money and some on most of those Japanese banks. But historically the index has been a lot higher. I still think there's further upside to come over the next few years. Number one, Japanese stocks are in a bull market. They haven't really been in a bull market like we're seeing at the moment since the 1980s. And I think so the stock market can go higher. We're seeing the Japanese public re-engage equities now for the first time and really since the 1980s. We're seeing inflation coming through, so it's no longer a good time to be keeping your money in cash. And the government's implemented quite a few reforms which are encouraging investors to get back into the market. So look, the Japanese bull market has probably got a lot further to run, and I think the Japanese banks are going to be one of the sectors that's out in front. With rising bond yields really becoming, and rising interest rates over there becoming quite a powerful tailwind.
Do you have a preferred Japanese bank at the moment?
I like Sumitomo Mitsui Financial Group, which is the largest bank in Japan. And, it's got dual tailwinds. It's not just the banking business that's having a big resurgence, but also Sumitomo is a major player in the wealth management industry. I think that is also going to have a huge recovery over the next 5 years as the Japanese rediscover their own backyard, really. They've become accustomed to investing overseas because they just couldn't get a return in the Japanese equity market. Well, I think that's all changing now.
Okay, so we'll move on to the Hang Seng Tech Index, another chart looking very good and looking like it's starting to turn around over there.
Yeah, look, we haven't had the definitive breakout yet, Patrick. But this index, it's exhibiting very similar patterns to other charts that we've put up today, including the CSI 300 and the Hang Seng. And I think a breakout is coming for the Hang Seng Tech Index, and we're going to see the path of least resistance for a lot of those IT, technology, internet companies. Path of least resistance to the top side. We saw Tencent Holdings really came in with quite a strong beat against what the analysts were looking for, and already we've seen that stock re-rated. So I think this is going to become a sort of a central theme for a lot of those companies.
Okay, so we'll move on to copper. I know copper's been something you've been talking a lot about. We've been focusing the members on the copper sector, and I think this chart is telling a lot, and we've recently seen the copper price continue to go higher.
Well, I think China coming back online, the property market bottoming out, that's all sort of happening as demand has been accelerating for copper anyway, as is evidenced by this chart with the big historic breakout to record highs on Friday. And, copper is a great way really to play the recovery in China, if you believe it. China is the world's largest consumer of copper. I guess what's also interesting is that as China rebounds and the economy recovers, it's also happening at a time where demand's shooting up in a range of other with a range of other catalysts, such as AI, which are going to require a lot of chips, a lot of data centers, or require a lot of copper. We're seeing the energy renewable story really begin to gather pace. Power substations, transmission lines, upgrading the grid, that's all going to require a lot of copper. And I think, if China's economy continues to grow, well, that's also going to be and recover, and the property market starts turning around in the next couple of years, well, that's just another big layer of demand. So, we're quite bullish on copper.
So on the demand side, which you've spoken about, what about the supply side?
Well, the supply side's very constrained. We just haven't seen new mine production come on board. We only have to look at what BHP is doing with Anglo American with the takeover. It's cheaper to go and buy another company which has got a copper mine that's in production than it is to go out and do a greenfields. And there's probably a 12-year lead time before serious new supply begins to hit the global market. So supply dynamics are really constrained. Meanwhile, demand is rising, and this turnaround in China is probably going to happen in the property market when that starts turning around in the next couple of years. It's further going to exacerbate what is already a very tight market.
Okay, so we'll now look at the Bloomberg Commodity Index. I think you ran this last week in the daily, so some of the members may have already seen this, but we thought we'd touch on it today.
Yeah, and I think the commodity index is pretty telling. It's pointing to a topside breakout. It looks very much like it's going to be sustained on the upside technically. And, this sort of comes back to this whole sort of thesis we've got, Patrick, about, the super cycle and commodities playing out over the next, probably over the next sort of 5 to 10 years. And, China is central to that case. And so, it stands to reason that if the economy continues to improve over there, so too will, the demand for commodities, which are going up now anyway. So I think, this Bloomberg Commodity Index is going to be a lot higher in years to come. And part of that's going to be due to, China really coming back with as a major force in the global economy. And I think, we're sort of seeing that with these big breakout moves in the stock markets, those stock market benchmarks, which, are looking ahead 12 months' time.
So as we move on, and we've spoken a little bit today about how to get exposure to the Asian market in Hong Kong, and we thought we'd profile the Fat Profits Asian managed account portfolio, which some members may be aware of our wealth management department and our managed accounts. But we thought we'd showcase this one as we're focused in here on the opportunity in Asia. And I know, Angus, this is a model that you're quite excited about. You've been pretty active putting it together, and we're getting a lot of interest from investors asking us how they can get not only exposure, but how they can do it through our managed account. And I thought you might want to talk to some of these companies that are listed here that are in the model.
Well, I'm not going to go down the whole list, but we've talked about Tencent Holdings, Sumitomo Mitsui, financial group, there's a lot of representation. These are our top 12 holdings. Of course, the model's got portfolio's got more companies than that. And what I will say is we do have a bit of exposure to gold. We do have exposure. These are not these are in alphabetical order, but not by market cap. We've got plenty of exposure to gold. It's allowed us to outperform during what was a very difficult time for China, Hong Kong stocks, over the last few years, and we're now reweighting some of that gold, physical gold exposure that we had back into some of these companies that we've been talking about. So, there's a lot to be excited over there. There's a number of companies that we like in China, Japan, and without giving too much of our secret sauce away, Patrick, I would say that we've got a skew towards technology, but we've also got some old bricks and mortar companies. The Macau gaming stocks, which lost 80 or 90%, during the pandemic. Gross gaming revenues are now back to pre-pandemic levels. So big opportunities there. We like Yum China, which owns 14,000 KFC outlets throughout mainland China, and it's still growing at a huge rate. So lots of opportunity, and I think the model portfolio is a good way to get a diversified basket of stocks, which is managed for you.
And it's a very cost-effective way for members to get access to all of those companies through the managed account portfolio. And we thought we wanted to share that with you today in this presentation. So if any members have any questions or would like to talk in more detail about how the Asian managed account may help with your investing and get you exposure to some of the things we spoke about today, please feel free to give us a call at the office, 1-300-88-1177, or you could email us to members@fatprofits.com.au. And I think that will end the presentation. And as I mentioned earlier, Angus, I know you're excited about your upcoming conference over in Japan.
Yeah, I'm very excited about it. We'll be, I think one of the keynote speakers is Prime Minister Kishida. So it's going to be fascinating listening to that. But also, just seeing what the general mood is with consumers on the street. I'll be looking at the property market and what's going on there. And of course, there's going to be an absolute plethora of speakers talking about all sorts of different facets to the Japanese economy. So it should be a very educational week, and I look forward to sharing some of those insights.
Okay,
with
thank you. And we thank all members for joining us in this special presentation. We hope you got some value out of it, and we'll look forward to speaking with you all soon. And Angus, have a safe trip to Japan, and we'll see you when you get back.
Thanks, Patrick.